All right, can everyone hear me? Looks like we have a number of attendees in here. I think we're ready to go. We're going to go ahead and get started. Stand by for just another 30 seconds. All right, fantastic. So we'll go ahead and get started. I want to thank everyone for joining us today. We gave a live market address in general a couple weeks ago, but things are moving pretty rapidly. Things are changing day to day with this crisis. We wanted to give a restaurant-specific market update and also just update you on some of the changes and progress that we've seen over the past couple weeks and how it's impacting things. So what we plan to go over today is we'll speak briefly to our single tenant team and expertise. Our team covers multi-tenant and single tenant retail, but we have an arm of our business that focuses on the single tenant side. We'll cover the state of the market, specifically around the restaurant sector, some negative impacts. I know that has been largely what has been in the media, and there are a lot of challenges that people are working through right now. So we do want to cover those, specifically on the casual dining and the quick service restaurant side. But we also would like to cover the positive light. So what deals are still moving forward? What are some of the positives that we're seeing, and what helps us see some light at the end of the tunnel? And then we'll give you a transactional velocity update on year-to-date data captured compared to year-over-year for restaurant-specific net lease properties. We'll go over navigating some uncertainty, how restaurants are proactively surviving the storm, both on the tenant side and landlord side. Speak to some of the small business resources and what small businesses can seek. And then in addition, landlord and investor resources, what landlords and investors can seek and how we might be able to help. So your hosts today are me, James Garner, and our partner, Jim Schiebler. Both of us handle single tenant net lease restaurants. Jim does cover multi-tenant shopping centers as well. My focus is on the single tenant side and helping us build out single tenant specialists. So we also have Aaron Bergland on our team. He covers restaurants in specific geographic locations. And then Reed Bedford is our bank specialist with a lot of things that are changing in the bank business model. It's great to have someone specializing on that side to be able to have our clients access as a resource and helping think strategically about these investments. Jim, why don't you cover a little bit about our team? Jim, you may be on mute. Jim, are you there?
I'm here on my cell phone, but I'm talking. You cannot hear me?
Speak on your cell phone, yeah.
Hi, this is Jim Schiebler. Sorry again for the technical glitch. So a little bit about Marcus & Millichap and Medifine Retail. We really thank you for the privilege of your time. We think we have some great information for you here, and thank you in advance. Marcus & Millichap, we have 50 years of specialization and experience through multiple cycles. We really provide dedication and support to our clients in real time. We strengthen our client relationships, and it's really what we do best during market disruptions. We are 3 times the specialist. And what I mean by that is we only do commercial real estate investment sales. We don't do any management or leasing. So we're true specialists. We also have a specific product type. Our product type is retail. And then we also drill down on the tranche within that concept and that product type. And obviously today we're concentrating on restaurants. And really James and myself and Aaron, we spend a good amount of our week concentrating only on restaurants. So we know we have a really unique perspective to share with you. Marcus & Millichap, overall, we have 2,000 brokers in 80 offices throughout the country, and really collaboration is our value proposition. Medifine Retail specifically was founded in 2009 by James Medifine. Last year, we did almost $140 million worth of sales volume. We pride ourselves in list-to-close ratio of over 95%. We currently work with clients in 37 states. And our theory really is that real estate is not bought, but it's sold. And that's our value proposition and how we position ourselves to really yield the highest, industry highest prices and industry lowest cap rates for our sellers. We pride ourselves on operating with integrity and transparency. We also look to build long-term relationships where we're not transactional based. We always say we want to build clients for life. And we work with most of our clients outside of a transaction because transactional velocity is only 4% annually. So we demonstrate our commitment, our expertise, assisting them to mitigate risk, maximize income, and also maximize their equity position of the property. So when they are ready to transact, we are most prepared to deliver really three things. So the highest strike price in the shortest time frame within the easiest process. And what we're going to concentrate on now is really talk about the state of the market. James?
Sorry about that. So these graphics just go to show kind of where we are today. Shelter in home order, the graph on the right shows you all the states where there is a shelter in home order. And the implications of that have been, the graph on the left, dine-in service has been suspended or restricted in those states. And so when you look at and consider all of the businesses, specifically restaurants, that are operating to serve all the communities and not just the main metros, but some of the smaller cities in these states, you can see just from a macro view what kind of impact that's going to have in general, not only on businesses, but our communities.
And this is Jim Schiebler again. So nationwide sales are down overall 47%. And let's preface by saying there's going to be a lot of negative information coming at you on this call. We want to make sure we give you all the facts and all the updated metrics. But we also have some great information at the end of the call, how to overcome this and how to create win-win in this situation. So with that being said, currently there's over $25 billion lost in restaurant sales specifically. 54% loss in off-premise sales, 44% loss in 44% of temporary closed, and then 11% of all restaurants may have to permanently close within the next 30 days. There are some pretty dire predictions out there, which obviously create opportunity on the other side, but let's talk about today where we are. The prediction is that between 20 to 30% of all restaurants throughout the United States will not reopen. They're either highly leveraged, they will be captured by the lender and as a bank real estate owned property, or the tenant will just have to abandon their property altogether. And then sales, obviously, since these metrics and these numbers as of March 22nd have continued to decline. And we have a basic graph for you here as well. It just shows you in red, really, in current real time, just stunning facts. Customers will not go out and eat restaurants, and this is their perception even in the future in this climate. 53%, 25% will order more restaurant food for delivery, and over 27% say they will definitely go through the drive-through as opposed to entering the facility itself physically. Now we're going to transition to the negative impact and how it affects investors as also tenants and operators. So transactions, they fell 42% in the week ending March 22nd. Restaurants obviously are moving to limited menu offerings. And then there are major struggles. The brands that had forward thinking and that prepared and really prioritized digital mobile app ordering, takeout, and delivery prior to the pandemic really were able to take advantage of this situation, and other concepts and tenants and operators that did not prioritize that model are really struggling to catch up. And some operators are closing altogether. Before the COVID-19 outbreak, on-premise dining represented 52% and off-premise 48% of overall sales. Full service restaurants experienced same-store declines of over to 70% year over year. Fast casual 50%, quick service a 30% decline, and fine dining restaurants are the worst performers during the month of March. And what's troubling is half of the small businesses report that they cannot survive another past 2 months under the current conditions of massive downtrending sales and hemorrhaging. Next slide, please. Darden has actually furloughed over 150,000 hourly employees. And Darden obviously is one of the largest restaurant operators and concepts in the country. Their weekly cash burn rate is about $25 million. BJ's recently laid off 16,000 hourly employees. And really this drop-off is difficult to rival at any other juncture in restaurant history. Nearly half of fine dining brands have shut their door. 72% of fine dining respondents through multiple surveys said they laid off 75% or more of their staff. And, currently QSR workers are striking in California because they're seeking increased hazard pay. They're demanding to be supplied with proper personal protective equipment, and that the restaurants erect protective barriers to protect them. We definitely expect this trend to increase as QSR virus diagnosed employees increases. We'll go to the next slide, please. You can see these two charts. Overall, there was a huge drop-off from the 8th of March through the 15th, and year-over-year sales for overall Darden is down about 24%. And then J. Alexander's restaurants are down about 25% total. Slide, please. Now, it's really interesting because although many QSR brands are not hemorrhaging, some are actually profitable, but many also are bleeding. Wendy's, for example, comparable sales ended in the week of March 22 are down 20%, and they have 46 temporary U.S. closures. And then, everyday opportunities for people to stop by a restaurant are definitely drying up. People are driving and traveling less. Public spaces are closed. Major events have been canceled, and just your everyday office worker going out to lunch as a traditional routine has completely disappeared. This statistic as well. This graph is for Starbucks, which is through the tri-state area of New York, New Jersey, and Connecticut. Both weekly and year-over-year sales have decreased a total of 40%. And February comparable sales in China for Starbucks China, because we're a couple months behind them by 6 to 8 weeks, we're down 78%. But by March 5th, 90% of the stores in China were open, 95% by March 24th, and stores were closed on an average of 45 to 60 days. Experts say we're tracking in a very similar way to China, but it may be a few weeks longer recovery period for the U.S. And on March 20th, Starbucks suspended the counter service and allowed only delivery and drive-through services. And Starbucks reports a 60 to 70% same-store sales decline at the end of March. Some other concepts that were struggling prior to the pandemic, those are really key to really focus on, because a lot of times these tenants they're using the pandemic and the COVID-19 as the reason why they cannot pay their rent, but they had major problems prior to this pandemic. We've illustrated about 10 different brands and operators that were in trouble, and we'll go through a couple of them. So Steak and Shake closed 107 locations last year. Ruby Tuesdays down to 490 locations from well over 700 units. They have a D minus credit rating, and many units are closing permanently. And they're saying, here are the keys, even though we have lease term remaining, not our problem. You figure it out, to the landlord. And we'll talk about some solutions if that occurs to your tenant later in this broadcast. And then, of course, Crystal was also, they filed for chapter bankruptcy location, and they also closed dozens of their locations. Go to the next slide, please. So unemployment. Total jobless claims increased for 3 weeks to 16.8 million. In fact, 10% of all U.S. workers have lost their jobs in the past 3 weeks. 2 million jobs lost. Now 2 million jobs were lost in the largest job loss on record in 1945. And that was when the manufacturing machine that supplied World War II was shut down. But it's really hard to describe that as a bad month now, where April 2020 will set a new record for most unemployed in 1 month, and unfortunately likely by a few times. The unemployment rate, the forecast that it would peak at 12.5% as 14 million people would lose their jobs, that is now looking very optimistic. The unemployment rate could hit 20% and may take years to get back to a more normal level. Go to the next slide, please. So you'll see the leisure hospitality loses over 4 years of labor gains. You'll see the spike down. 10 million jobless claims in 2 weeks is simply not the realm of what anyone thought was possible only just a couple of months ago. And on the graph on the right, it took 2.5 years for the unemployment rate to rise from 4 to 10% during the Great Recession between 2007 and 2009. And this time it only took 2.5 weeks to occur. Next slide, please. So now we're going to go into some areas. We'll cover one more slide. So the tipping point really, as you see the incline of sales, because overall year-over-year sales for restaurants were up from 2019, but the tipping point was really March 11th, and then it's been really overall a downward slide from there. And in our next section, we'll go over some positives, which we're very excited to share with you.
Yeah, and just to cover this real briefly, so kind of tied into what Jim just mentioned, after the 11th, it took a couple days for things to pick up, but the closures really surged in the past, towards the end of March. This was the week of March 22nd, as some of those new shelter-in-place orders were put in. New York City alone had a staggering 70.4% of restaurant closures. And then the brands that remained open under limited capacity, they saw a 68% decrease in year-over-year sales on March 22nd. And the week ending March 29th, for open restaurants fell roughly 60%. But you can see the graph as the sales declined over just the few couple days as really things started to move on. As Jim mentioned, there are some positives. And so we want to make sure to harp on that because we're not hearing a lot of those on the front lines of what the media is portraying, but we're experiencing a lot of it on the back end. And we thought it would be good to share with everyone, some of the good things that are going on. Jim, why don't you cover adapting tenants?
Great. So as I mentioned a few minutes earlier, the deliver and drive-through concepts that really prioritize those components, they definitely had a head start and advantage to navigate this climate. The tenants and concepts that did not implement these initiatives, they are struggling and they're struggling to catch up. But the good news is they will definitely emerge stronger and more capable within a compressed timeline of efficiency as a result. Panera has shifted. They have over 2,000 locations that are now selling groceries, and customers can combine restaurant and grocery orders for delivery, pickup, and drive-through at their locations. And the Subway is also testing that model on 100 California locations. We'll go to the next page. And you'll see some additional statistics of some successful tenants. Domino's giving away 10 million slices of pizza. Little Caesars donating 1 million pizzas to hospital workers and first responders. And there are some tenants like James is going to mention as well in this broadcast. There's a few tenants that are actually doing well. One is specifically is Wingstop, where prior to the pandemic, 80% of their sales were carry out and delivery. and they're up 8.7% for the entire month of March. They have a free delivery program for orders $15 and up through the end of April. And, there's some trends as well. Sales during weekdays are superior to weekends. Transactions are shifting more towards family meals than independent or individual orders. And trends appear to be stabilizing, albeit at significant decline.
And so I wanted to give a specific case study. There are some operators, franchisees of restaurants that we're working with that are seeing and capitalizing on what's going on. It really takes a creative mind to pivot and take advantage of some of these items, but the operators that we're seeing that are doing well had plans to implement a number of these processes prior to. And so they had already gone down the road of having some of this in place. This one particular operator, they acquired 4 Sonic drive-in locations in Louisiana in December of last year, and they've been working on improving sales at those locations. But I wanted to share some actual figures with you just to show you how, although they have been impacted by what's going on, they pivoted and have actually continued to see an increase in sales. So their unit sales for February were over a 17% sales increase a year over year. That was partly due to some of the new processes that they were implementing outside of even knowing that this crisis was on the horizon to drive more traffic. They had been working on building a loyal customer base versus what the previous operations were doing, and improving the customer service. And so they've seen significant sales because of that. So through March, before the lockdown, they continued that type of growth. They had 18% sales increase year over year. And then the following week and a half after lockdown, their sales growth took a big hit. Although they were still up 2%, they weren't seeing the regular year over year growth that they had been. But as soon as they noticed that was going on and that happened, they really started to pivot and think outside the box. And that's what a lot of these operators are doing that are doing well and positioned to push through this. They started to implement a number of processes for outside cleaning, indoor cleaning. The Sonic drive-in model in particular, by no design of a pandemic, was actually perfectly positioned to capture market share during something like this, where most other restaurants are closed. You don't have a dine-in area. Every single car is basically like you have 18 different drive-thrus, because you have single car spaces to go ahead and capture your meal and do it in a contactless way. And so in addition to that side of the business model, this operator also started to improve other processes for adding value to the client, such as making sure that everything's clean, or what Chick-fil-A has been doing, where everyone delivering food is wearing gloves, wearing masks, delivering food actually in a bag within a bag, just to help customers feel safe about coming back over and over again and recapturing that loyal customer base while others are not. And so due to implementing some of these items, they are now, for the month of April, so far trending 14% up in sales year over year, even after being closed for Easter. So, on Sunday, yesterday, they closed for Easter, and they felt comfortable doing that because they are still continuing to do some of the things they need to drive guest volume, even with everything that's going on. And they're not the only ones. I mean, there are other ways that other operators are positioning themselves for long-term success. And part of that is strategic diversification of the portfolio. Some of these multi-concept operators are doing a good job of identifying, different concepts, different offerings to diversify that risk. And so making sure that you have a good mix of drive-through or good processes for carry-out, even if your concept doesn't have a drive-through, is important. And that way, if there's any one of these concepts that your operator may be operating that is vulnerable to something like this, they mitigate those risks by having alternative concepts that might do well. So drive-thrus have been important, additional takeout and delivery processes, and the operators that are working through and implementing some of these and finding success, they're still looking at new development opportunities and then also acquiring existing units. There's going to be a number of restaurant franchisees that are having some hard times, and they're going to be in binds. And some of these other operators are going to be well positioned to take those over, help them with an exit strategy, and also be able to improve their existing footprint and continue their growth. I think that the best idea and the most successful operators are growing slow and low in the same way that you might grill a rack of ribs. So taking time to settle into those new units, making sure that you're doing it appropriately and that they're humming before you continue to grow further, and then low leverage and a mix of hard assets so that, if you ever do need to access some capital, you're able to do that. And so we'd like to roll into transactional velocity, just give you an update of what we're seeing in the net lease restaurant sector in terms of actual sales figures. So annually, year to date, the figures are surprisingly similar to end of year averages for 2019. Now, I wouldn't look at the total transactions because we're doing year to date for 2020, but you'll see that although the sale price so far year to date is lower than the average sale price for last year, there's only about a close to a 20% basis point drop in cap rates, but that's actual compression, which is interesting. So, I would take this with a grain of salt. It could be a function of cap rates adjustments. They're just not yet being reflected on sold transactions. But over the past couple months, we have seen investors taking great advantage of the low 10-year and low interest rates. And so, some of that compression could be due to that, and we just haven't seen some of the issues that we're currently seeing today catch up with actual market sales. So that's annual year to date, but if we look at the first quarter, which is very close to year to date, but the transaction velocity compared to last year's first quarter, it's down 30% for QSR deals and 79% for casual dining deals. Now, overall price points are down, cap rates are higher, and rent per square foot on casual dining deals are also down. QSR rents are staying close to equal for year over year, and that's just based on what we've seen close year to date for the first quarter. And then if we break it down even further and look at March versus March of last year, I think the most telling is the drop in transactional velocity. March 2019, we tracked 32 quick service restaurants as sold, and this year in March, 19. But I think casual dining was the bigger one. 25 transactions in March of last year and only 5 in March of this year. Now, none of the comps that we researched on the casual dining side traded after March 13th, which was basically when all these shutdowns started beginning. So you will notice that March year over year, the casual dining comps, they're lower price points, price per foot, and rent per square foot. And I think this is just a good indication that the deals that had been moving forward when some of the first starts of the crisis were coming apparent were probably driven more by core real estate and replaceable rent. Now on the QSR side, it's fairly comparable outside of the slowed velocity. A lot of the metrics were very similar. So it's interesting data there. It's important to note that we have not seen an increased cap rate on closed deals yet. However, we do believe there's an adjustment coming. So we are hearing of deals now going to contract or being offered at higher cap rates. It really depends on the asset and depends on the investor, because there are some people now that are potentially more motivated to sell due to needing their cash for other reasons, for other business ventures, things like that. But we do believe there's still a market to drive some of these lower cap rates, as long as you have the time to go ahead and access those buyers, because there are a number of buyers that are exiting their stock market positions and looking for hard assets. And we believe that you can still trade at compressed cap rates as long as you're willing to spend a little more time. The closer we get to climbing out of this and getting doors back open, the more ready buyers are going to be to feel comfortable moving on deals at these lower cap rates. So the closed cap rates appear lower than the 2019 averages, but I would assume that that's due to probably as things started to unfold, the riskier higher cap rate deals were the ones being dropped. And so the deals that continue to push forward were more likely the stable corporate credit, lower cap rate deals. And so that's why those data points might indicate the lower cap rates. And so how do you navigate the uncertainty in the restaurant sector? We're going to cover a number of ways that franchisors, franchisees, and also landlords and investors are trying to work together to come out of this. So This is an example of many franchisors that are accessing their credit revolvers. So a revolver is basically a credit vehicle for you to access liquidity in the event of an immediate need for operations capital or something like this. So this is just an illustration of what kind of revolver capital these franchisors are accessing to keep some cash on hand without really knowing when we're going to be back up and running. And I think although when you look at what has bounced back in China, the average of 45 to 60 days being closed, there's going to be an additional ramp up period because you're not going to hit the on button and sales are just going to pour in. They're going to need to grow those sales over time. So I think a lot of franchisors and franchisees are planning at least to have 6 to 10 months of capital to help them mitigate those losses and get the sales to climb back up.
Thank you, James. So a couple of major concepts and tenants, have some examples here. So Cheesecake Factory furloughed 41,000 workers, which is 91% of their employee staff, cut the pay by 10 to 20%, announced that they will not pay rent for April, and also other tenants are really limiting any type of spending or CapEx to maintenance only, and any type of new construction or expansion is really put on hold and delayed. Next slide. So Darden restaurants, if all store closed, would burn $40 to $50 million per week. Cracker Barrel, for example, acquired almost a 60% stake in Punch Bowl Social last year, and they actually refused to bail out Punch Bowl Social and took a $130 million impairment instead. Next slide, please. So really, new restaurant environments is going to be adapted for all concepts, even once the reopening occurs for the majority of the concepts. And that's really going to include seating capacity, proper distancing of tables and seating. Really, it's going to force the operator as well to rework the entire formula as far as volume and pricing and, profitability, because their entire seating capacities, their turns, peak levels, and projected income is definitely going to be compromised. So they're going to need to reforecast their entire model, and obviously we don't know what that looks like. Cleanliness and presentation of establishment is going to be paramount. Guests will need to see everything from frequent cleaning of high-touch areas to employees in safety apparel and uniforms and gear to make sure that the food is covered. The good news is that most of these practices should now be business as usual, specifically by the time the restrictions lift. And each brand needs to obviously build hygiene into its culture, during this particular downturn. And then there are a couple of statistics to the right. Eating inside restaurant dining areas, customers are not comfortable at this time, 52%. Shopping during very crowded times, 63% are not comfortable. And any type of bar, nightlife, really 69% of patrons or customers are not comfortable in that type of environment or climate. Next slide, please. James?
We're going to cover what resources there are available for relief, both on the tenant side and also on the landlord investor side. It's important to note that, delivery, drive-through, and takeout represent about 50 to 60% of all total restaurant sales, but it really depends on the sector. When you look at fine dining, it's less than 5% of their sales for Ruth's Chris, and then Wendy's alternatively as a quick service restaurant, it's greater than 70%. Different restaurants fall within this depending on their business model and depending on what processes they've implemented. But that's why it's so important to implement some of these processes and mitigate those risks if you are more of a fast casual or a casual dining concept. And then like Jim had mentioned prior, so even some of the fine dining, what they're implementing are these family meal kits or family meal discounts to try and capture some of the takeout and delivery from their business model.
And overall, as far as pizza delivery, Between the three major companies, they'll be hiring over 60,000 new workers. Other concepts will generate 10 to 20% of historical sales, but at lower margins. And Chili's, for example, is only capturing 30 to 35% of prior year sales, but again, with much lower margins.
And so taking advantage of the third-party delivery is going to be important. But I think even more important than that is some of these concepts determining processes for themselves to handle this in-house, only because a lot of these third parties right now are waiving some of their delivery fees, and that's great. But without the operator or franchisee analyzing, what kind of added bottom line that creates, if they're increasing sales but it's still cutting into their bottom line, it's not going to help. And I think while they may be capturing some to the bottom line while these fees are waived, they're going to need to take a look at what that's going to look like when the fees come back into place. And so I think some of the operators and franchisees that are implementing processes for them to take advantage of additional sales outside of these third parties are the ones that are going to be able to see bottom line growth versus just maintaining sales growth.
And there are a lot of franchisors working to assist and alleviate the bleeding for the franchisees. And that includes deferring remodeling and new locations and expansion, providing grace periods for the royalties and the marketing and ad fund payments, reducing royalty payments, and also deferring rent. And again, we're going to get creative in another couple of slides into the future here about how that's being done and what we're seeing in the market. So some additional small business resources that we've identified. Obviously, White House is seeking additional funds for the Paycheck Protection Program. They're working to secure an additional $250 billion for the program as passed as part of the CARES Act stimulus plan. Currently, it provides $349 billion in forgivable loans or grants to small businesses, mostly for payroll, but also for rent and utilities. But that has caused fears for a lot of operators and small businesses that those funds may be depleted. So they're rushing to be first in line. And it's difficult to secure those funds due to this overwhelming demand. In fact, the National Restaurant Association Education Foundation's Coronavirus Employee Relief Fund, which was just recently implemented and launched, was so popular that it crashed almost immediately after it opened for applications.
And so in addition to that, you talk about additional resources. You're going to see a shift on the tenant operator side to some of the things that we've already been talking about. The implementation and process of regularly wiping down tables, kiosks, other things that people touch, more food covers. You're seeing this not just on the restaurant side, but on grocery or really anywhere that you're going to interact with the cashier, providing disinfecting wipes, employees visibly wearing food safety apparel, creating more space between tables. It's hard to know how soon businesses are going to become open again, and then how soon the rush of guests are going to come. And there's probably going to be a lag time where customers may feel comfortable in going out, but still want to maintain their distance. And so having fewer seats more spread out may be a result of some of that. And then making safety convenient for customers, finding ways to implement processes where customers may not have to touch door handles or touch things and remain contactless in a transaction, including payment with mobile ordering. Like I've mentioned, a number of concepts have already started adapting mobile ordering and things of that nature and have done a great job of doing it. Some of the most notable ones that are easy to use on the app include actually Sonic or Taco Bell, Chick-fil-A, and that just goes to show that they were already well prepared. And I think now, due to all this, there's going to be a number of concepts that start to adapt and create the technology needed for those new ways of driving volume.
Thank you, James. So strategies for landlords. We've been on the phones, 30, 40 hours every week with our clients. we're seeing it run the gamut as far as what's being negotiated. But we definitely want to. Obviously, we've seen everything from being sensitive and empathetic, because in more cases than not, it's no fault of the tenant or operators. It's just a bad roll of the dice and a bad draw. And so we're seeing landlords say, hey, how can you being proactive? How can I help? What can we do? How can we work together? And then we're also seeing the other side of it, which is really difficult and not pretty, where some landlords are attempting to capitalize on the vulnerability and the weakness of the tenant. So certainly find that balance. We want to recommend that. Be proactive. Assess your tenant situation and level of vulnerability. Are they fortified? Are they insulated? Are they still doing extremely well, like a QSR that has the majority of their business pumped through their drive-through to begin with? Or are they a casual dining that they weren't equipped and their concept and service is not linear with to-go food, and the level of desirability and deterioration of the quality of the food are factors where it doesn't make sense for them to be open. Obviously, they're bleeding, they're hemorrhaging, and they need help. So really assess and be proactive. And then some techniques and strategies we've seen and we've actually recommended is to be able to provide an abatement based on what the aforementioned, and but for that void of payment and that concession, orchestrate a payment plan over the base term and amortize that difference and that void. You could also, what's very common is adding the same term to the end of the base lease term. So if there's a 36-month lease in place and you're giving, that landlord specifically is giving a 3-month rent abatement, now they're going to tack that same amount on the back end of the lease, and they're going to have a 39-month lease term. Also, some landlords are getting creative and they're doubling the term. They're saying, okay, if I give you 2 months, then I'm going to give it to you free, but you're going to pay me back 4 on the back end on my lease. So now my lease is now not 36 months, but it's 40 months for 2 months in return. And then others are doing a combination. They're giving them 50% for 3 months. They're giving them 75% for the following 3 months, and then they go back to 100%. And some are giving them complete relief, or they're putting it on the back end of the lease, or they're amortizing it throughout the term. But this is the time to get creative and create a win-win. And so there are a lot of solutions out there where the landlord's not just taking the hit, and it all doesn't get just dumped on their shoulders to absorb that void. And then also there are win-win situations as well. So we'll give you some ideas here. You could ask the tenant if they have 3 years left on the lease or a year or 2. You could ask them to extend that next 5-year option or whatever that next option period is, to do that early in relief. And it certainly increases the equity position of the asset if you're going to also just provide a couple of months relief. You could also add the term to the back end of a very lengthy lease and say, okay, well, I have 12 years remaining on the lease. If I give you, say 2 months off, abatement, and then another 2 months or 3 months at 50%, will you exercise your option now and take that 12-year lease term and make it 17 years? That's also semi-popular, and we've seen that. And then also, there's always going to be negotiations for a reimage, particularly at the expiration of the base term, as franchisors require their franchisees and their operators to do that every 5, 10, 15 years. And so the tenant will look for the landlord contribution, and this is a time that you could negotiate that on the front end. And then, really assess your lease as well. We ask you to get us involved and allow us to help you. If you wanted to send us your lease, we can dive through it and dissect it and really examine the areas of weakness and vulnerability that translates to value and risk. And some of those include, transitioning a double net lease to a triple net lease, the removal or adaptation of an assignment clause. We always recommend that our clients have sales reporting provisions in their leases, and that way there's always a healthy level of accountability. The owner can always know and have a finger on the pulse of exactly the performance of the tenant. And then also, when it comes to the ultimate lease negotiation at the expiration of the term, the landlord always has the position of leverage. So maybe that's an incorporation and implementation of a sales reporting provision, either quarterly or annually. And then, maybe some leases have a percentage rent clause. We work with a couple of clients now that obviously that's a real negative, because there's no way they're going to hit that provision and that threshold and breakpoint this year. So maybe that could be eliminated, or it could be converted to a traditional lease, or that breakpoint could essentially be negotiated. Any type of a rent holiday that on the back of a lease, usually those are drugstore related. Lease increases could be negotiated as well, because often we see 1% or 5% every 5 years, which is obviously less than inflation and the CPI. Or you could also solidify or increase the guarantor in the lease. Often there's a high level of ambiguity of exactly what, particularly with franchisees, what backs the lease. And to solidify that language and have it in writing and memorialized, would be an advantage. So there are opportunities for the landlord to be able to work with the tenant and maybe identify those areas that could fortify your position as a landlord with your property. And we're happy to help you dive into that. Each situation is very specific. Each case is different, and there are many complex components that require expertise, but they also require creativity. We pride ourselves in real time and on our availability and response time.
And I'll add that, many of the resources that tenants are taking advantage of, landlords and investors also have access to. So I think that investors and landlords should be looking into those and applying for those themselves, and then seek your expert specialists. So obviously we're here to help where we can, but you're going to want to speak to your attorneys, proactively talk to your CPAs, your 1031 exchange intermediaries, any other investment advisors, your lenders. Make sure you have a comprehensive understanding of what resources are available to you per each of your expert specialists. I know that the 1031 exchange, if you've been in an exchange while this has been going on, some of the timelines have been extended for you. And we can share some of the details of that as well. But do reach out to your other expert specialists on their insight on what else you can be doing to make sure to protect yourself, protect your investment, and protect your tenants.
Thank you, James. So in this situation, based on the forecast, there's going to be an abundance of vacant buildings, and it might happen to someone on this. And, what do you do then? And so we want to go through briefly the steps and precautions that you can take prior to that occurring. Number one is, how is your tenant performing prior to the pandemic? How were they positioned? Were they fortified? Were they insulated? Or were they highly vulnerable? That includes sales, product type, population growth, and the competition in the area, the rent to sales ratio, and the rents compared to the market. Those are all 6 or 7 questions you want to know the answers to. Secondarily, we do something called a SWOT analysis, which is an acronym for strengths, weaknesses, opportunities, and it's an acronym for strengths, weaknesses, opportunities, and threats. And it's really a healthy exercise. It takes us some time to examine and go through multiple models and do a full dissection. But once you have that SWOT analysis in your hand, you'll know exactly where your property stands. So those are the questions you want to ask yourself and make sure you know the answers to. And we certainly can help you with that in real time. Now, if you do find yourself with a dark building and the tenant does vacate, which we are in that situation right now with a multitude of different owners and landlords, what we do is a variety of different elements. But number one is we do a tenant and land analysis. And it's a pretty sophisticated proprietary model that we designed specifically for this instance. So we've outlined the steps, on the proposal, on this presentation, which we can obviously send everyone. But we identify the highest and best use. We do a market rent analysis to determine, what is the local rents. We do a leakage analysis to determine what the gaps are and what's needed in that community. And then we also we pinpoint the concepts and the product types that would be the highest and best use, that would be the most fitting concepts and businesses to be able to backfill that and convert that current abandoned building or dark building. And then we run pretty sophisticated financial models. We dual track that with land analysis and understand the price per foot as far as per acre and the abundance or lack thereof of vacant land in the immediate area. And then once we gather all that information, we synthesize it, and then we make our recommendations of who would be the best tenant, the best concept, the best product type, what they would pay, what their typical lease term is, what that would look like from a cap rate perspective, and then ultimately what that equity position would be as far as the actual price, whether it would be a hold or a sale. And then we also subtract the development costs and contingencies of what it would cost to convert that actual building to one of those ideal tenants or product types. And then in closing, just a few more slides, everyone. Clients are saying, hey, why would I ever sell now? I'm just going to hit the pause button and just wait. But there are a number of reasons why. Now, obviously, we've outlined a variety of them, but I'll cover a handful. First, we've entered a recession. In our opinion, only direction of value is down. Leasing will be in pause mode and vacancies will soar. Cap rates will increase. Cost of debt will increase as well, which will also be linear with the cap rates. So there will be a limited spread. And if an owner plans to sell within the next 5 years and their objective is to maximize the price, which obviously it always is, then we recommend sell sooner rather than later or hold long term. And at this time, a 15% value reduction may look like a windfall for the seller compared to what's on the horizon. That might be 6, 12, 18, 24 months from now. There's also going to be limited inventory competing with your asset. And, we offer also very creative strategies that we are working with a lot of our current deals that we're either have on the market, we have under contract, or heading to the closing table to make sure that that buyer is protected, that buyer is insulated, but it also provides minimal risk for the landlord throughout the contract process. And there are very creative strategies that create a win-win for both parties. And if the landlord and seller has already come to the fact and the realization that they've earmarked this property for disposition and they'll be moving on from it, time is definitely of the essence. So if that's your situation, we certainly would welcome the opportunity to talk to you further. Next slide is going to be the opposite, right? Why would I buy now? And why would you buy now? Well, really to have a long-term vision and know that some of these product types are bleeding right now, but in the big scheme of things, they're actually in vogue. And so it's just a temporary glitch that these operators and landlords need to navigate through. So with a long-term vision, often a legacy or long-term hold, there can be a windfall that's created as a buyer. You're also going to have limited competition as a buyer. The seller is also, in many cases, already checked out mentally on the property that they're selling, and they've already identified other properties or investment vehicles. And in many cases, those are at a discount. So for example, if a seller can sell a property at a 12% discount, but then they're going to reinvest those proceeds into a 20% discount, then it makes sense for them. But for the buyer, they also receive that huge discount on the front end. And then the old adage, as we all know, one investor's problem is another's opportunity. And certainly in this environment, cash is king. A quick cash close can yield extreme opportunistic prices. Okay, and James.
Yep, sorry about that. So, we're wrapping this up in closing. We hope this information has been very useful. But obviously, everyone's situation is different. We've given some general ideas on the reasons why it might make sense to buy or sell, and even with everything that's going on. But we really can't give any recommendations unless we sit down and discuss further detail with you, because there's a number of things to look at, especially your long-term goals and what you're trying to accomplish with your assets on the long term. And so, like we mentioned before, we're happy to take a more strategic look, help you do some long-term planning and business planning around current assets or prospective assets. Please do feel free to reach out. We have fielded a few questions, so whoever wants to stick around, we'll cover a few questions, but we do appreciate your time. We hope this has been useful for you. And please provide us feedback if this is something you'd like us to continue to do in the future. So one of the questions we fielded is, why don't I just make my tenant pay and hold them in default if they don't. So this is one of the more rigid approaches that Jim was referencing earlier on. Jim, what do you think about that approach? What are your thoughts on that?
The most successful investors that we see create a long-term win-win for their tenants, and we identify those investors of having a genuine interest that the tenant is profitable. And so by having that hard stance during this time of vulnerability and need, if the tenant survives, which is not likely based on that hard stance, they will also have ill will toward the landlord. And any opportunity they can utilize to take advantage, they certainly will. And B, we all do believe this is in many cases a temporary time, and there are creative strategies that don't force the landlord to take the void and take the hit 100%. Obviously, there are small business loans that the tenant is applying for, but also the landlord is also applying for, that will mitigate and alleviate some of those losses. But then also back to our earlier slides is really be creative. We look at it like it's a partnership. And if you genuinely have an interest for your tenant to be successful, it's going to improve the probability of a long-term profitable investment for yourself, both from an income and equity position. B, it's going to create great will from your tenant, and they will remember that. And you'll often create tenants for life. And then number three, it's in this climate, if you can do that and you're able to, it's just the right thing to do. So again, back to another slide that we recently executed, which is the tenant land analysis. You'd be surprised. A lot of landlords that we work with that have taken that stance in the past and kind of called the bluff of their tenant, and then they come back and then the tenant leaves in the middle of the night. The landlord is hamstrung with huge carry costs, not insurance, property taxes, utilities, but also in many cases they have debt service that they have to continue. And then coming in, the tenants now, the new tenant for a potential conversion has the leverage. And often we ask our clients, hey, how'd you wind up owning this property? And they say, Jim, I didn't have a tenant. It was dark for 12 months. I figured anything's better than nothing because they were bleeding. But yet they settled on a rent that's half of the market. And they took their equity position and cut it by 50%. So ideally, it's best for a variety of reasons to work with your current tenants and create a win-win long-term solution.
I have a question here. Someone's saying that, I'm currently selling a property, and amidst all this, moving down the line with the buyer, does it still make sense to move forward or reevaluate? And I'll take this one, Jim. I think that you definitely need to reevaluate, but it doesn't necessarily mean that you shouldn't be moving forward. It really just depends. It depends on the asset, the risk profile involved, and more importantly, what your long-term goal is, what you're trying to accomplish. Like Jim mentioned, there may be some opportunities on the other side for your exchange to secure a discount. And so would it make sense to continue moving forward with a currently engaged buyer if they're asking for a discount? That's a potential. But you also have to, everyone's going to be different. You have to weigh your own risk threshold. You have to understand the viability of the business model within the asset that you're selling to understand, is the request for a discount warranted, or are there ways to overcome a discount and maybe maintain that price moving into contract by either the seller, guaranteeing rent for the next 60 days or, some sort of protection within a contract to maintain that value on a sale without giving up a discount, and also be able to accomplish your goals. Because if you were moving forward on a sale, there was likely some reason. And so now it would be time to reevaluate those reasons, understand what your options are for your next landing pad, and adjust accordingly. Another question we received was, should I demand certain lease changes now if my tenant is not paying rent? Jim, why don't you cover this one? I think you touched on some of this earlier, but should demands be made if the tenant is just not paying rent?
Good question. I think that each case is going to be different. I know we say that a lot, but it's very, very different based on location, concept, and the intricacies in the lease itself. And of course, what the tenant's vulnerability and what they're ultimately paying currently and what they're asking for. But I would say, yes, there is a window. Obviously, it needs to be creatively and smoothly negotiated. But there is a window. I mean, if you're a tenant and you're bleeding and your reserves are hemorrhaging and you see an oncoming train on the horizon as the light in the next 2 to 3 months, you're going to be grasping for opportunities to trim and save. And so the landlord has a unique position, probably a one-time position in the lease life, to be able to understand what the weaknesses are of the lease, understand what components are crucial to the intrinsic value, either more valuable or vulnerable as far as value up or down. Identify those and then creatively put those on the table to negotiate with the tenant. Often the tenant doesn't see that as a huge component in general, and in this environment, in many cases we've seen them, lean and be lenient on those components. Again, it could be a double net lease to a triple net lease. It could be exercising the option early. It could be the rent increase. It could be a assignment clause. But yes, there is a unique opportunity now. Again, done with tact and finesse. And we're happy. In many cases, we often play the middle person as the liaison, and sometimes we're framed as the bad guy, which isn't such a bad thing for the landlord because they can continue to maintain their positive relations with their tenant and allow us to, either be the bad guy and frame the recommendation, or give that consultation of what we believe would be most suitable to negotiate and come back to as far as the hot button of what that component is for the landlord and how to negotiate it down. So it's definitely a unique opportunity that every landlord should certainly consider. Again, it really comes back to the lease and the intricacies within the lease itself.
Thanks, Jim. We have a few more questions. We're going to continue to answer questions. We are approaching just over an hour, so if you do leave, we will put this up afterwards as a replay, but we're going to continue fielding some of these questions. So the next one I have, many tenants, especially restaurants, immediately sought blanket relief from landlords, stating that it was impossible for them to pay rent. And from a landlord's perspective, we don't get to enjoy the ups when these tenants are doing great, but now we're being asked to enjoy the downs when these tenants perceive they are struggling. Should landlords request transparency from tenants to see if they really can't afford to pay rent? Shouldn't the tenants willingly provide that information if they, in fact, cannot pay rent? And I think this, I can field this real quickly. It says that this question is more so targeted towards large national brands, not mom and pop restaurants. Actually, we've seen more of the corporate national brands making these requests more than we have some of the franchisees. And it seems that the franchisees, although there are a fair number of them asking for these requests, they're more willing to be open about what's going on in that specific unit level. I would recommend that, if they're saying that unit is struggling, that you request some more information and transparency, because at the end of the day, it should be a win-win where both tenant and landlord are working together, and they should be willing to provide that. Now, I know some tenants kind of hold the opposite approach, and they believe that, that's their proprietary information. They shouldn't have to share that. But I think there's a fine line when you need these sort of requests. I think that, the landlord wants to know how to protect themselves, and understanding that it's a true need to be more willing to work on a win-win. whereas some of these corporate tenants are just sending what look like templated letters making these requests. And it could be perceived by the landlord that they're attempting to capitalize on the situation and just get rent reductions across the board. Now, that may or may not be the case, but that is how many of them are being perceived right now. And so I think that if they are requesting something specific, then it's fair for the landlord to request something specific in terms of transparency in an effort to find that win-win. Another question we have, what are your thoughts regarding a restaurant concept who has a sublease, a non-restaurant essential business already in place, but claiming relief? So I assume this means, and Jim, I'm not sure if you want to share some insight on this, but it sounds like, there's a restaurant in place who's seeking relief, but they currently are already subleasing the property to a non-restaurant essential business that may or may not be doing well. And so it sounds like the question is targeted towards what can the landlord do to protect themselves when their actual tenant is requesting that relief. However, they know that they're collecting rent from a sublease. Jim, you have any thoughts on that?
That's tricky. I think it would be case by case basis. I mean, we need to dive into that particular situation. That's unusual. I think that the tenant, who's the restaurant operator, is going to qualify for relief from the Fed. And, depending upon the lessee, potentially they are as well. So I think that would be a case by case basis. We really need to understand the dynamics, I think, like James mentioned earlier on the call, transparency is going to be key. Any tenant that's going to ask for a reduction or an abatement, the first thing that they need to supply is in real time weekly sales reports to understand, where they were and where they are. And obviously those can be memorialized. And then once that information is provided, then a variety of different creative strategies can be examined and considered and implemented. But I think that's really the first step. And I would say it's really a case by case basis.
I agree. I mean, it's, I think it would be important to know the details of the sublease, and it depends on if that information is accessible. Is the tenant willing to share that information, or do you potentially have that information already in hand? But if the sublease is covering or their rent obligation to you or more, then it may be justification to say, why would you need relief from this specific location? At the same time, some of these tenants that are going through these challenging times, I think they're just looking for help across the board. And as investors, landlords, you also have to protect yourselves just in the same way they're going to try to protect themselves in their business. One of the other questions is, do you think a force majeure clause could legally apply a pandemic as an act of God? I've heard a lot of back and forth on this, and I'll share my thoughts, and then Jim, feel free to share your thoughts as well. But I've heard both cases. Speaking to a number of attorneys and contacts that are more familiar with the language, it seems like the consensus is that in most scenarios, force majeure does not apply unless it's specifically laid out that a pandemic would fall under force majeure. Now, I have heard of a few cases where some attorneys are working to create a precedent for it to be, and then some of the new language we've seen in contracts or in leases, the language around a pandemic is beginning to be added in there to make it more clear. So I think it really just depends on the language of the lease. Obviously, we review a number of leases and we can give our insights, but I would really recommend that you speak to your attorney and get their thoughts on what type of protection might be covered in the specific language of your lease. Jim, do you have any thoughts on that?
No, I think you covered it. I think it's case by case, and it is all the devil's in the details of the contract or the lease regarding the force majeure clause. There's there's others that are like act of God or damage and destruction that we've seen come into play as well. So I think it's really a case-by-case basis and aptly suited for your counsel.
We'll take one last question here. It says, what have April's rent collections been for TripleNet, QSR, with drive-through tenants? They say, I understand many or most corporate, small and large franchisees are now not paying rent. And what have the landlord investor responses been for those above whose dining rooms are closed but are otherwise maintaining uninterrupted drive-through operations? I think it's a mix. I think all tenants are handling it differently, and we're hearing a wide range of communication, from proactive communication of requesting a rent abatement and engaging the landlord in a conversation prior to rent coming due, all the way to having no communication, not hearing from your tenant at all, and the next thing you know, the rent just doesn't come in. Like we've mentioned before, we believe it's in everyone's best interest to be proactive. Even if you're not hearing from your tenant, it might be worth it to at least just reach out and let them, acknowledge what is going on, let them know you appreciate them, working hard to maintain the integrity of the lease terms that were agreed to, but also letting them know that, they're going through a challenging time. The last thing you really want is to wake up at the first of the month and the rent isn't due, but you still have your mortgage obligation. And so part of that is also being proactive with your lender. Some of the investors and landlords we're working with, as soon as they receive a letter from their tenant, even if it's just a request or them letting them know, that they're having a challenging time, they've been reaching out to their lenders and forwarding that information just to make them aware. So even if you're not requesting something from your lender, giving them a heads up in the event that things do go down a path that is worse, you've at least given them some transparency about what you're working through on your end. And so I think it really depends. Even the concepts that have uninterrupted drive-through operations as a whole, they're down by 20-30% year-over-year sales. And so if those operators or concepts have not planned for that and they don't have cash reserves to overcome that, that can be really challenging and still may warrant, request for some help, because this isn't something that happens every day. Obviously, this is an unprecedented crisis that everyone's working through, but it really just depends. Jim, you have any final thoughts?
Agreed, James. Well said. I think it depends situation by situation. It's interesting, right? We see all walks, because we see some really noble tenants that could take advantage of this situation. One tenant in particular that's only requesting a 30% rent reduction for 1 month of rent. And they said this is a one-time request only, and they were super polite asking for that. And I spoke with a number of landlords that have this same tenant, and they were all happy to oblige because of the way it was delivered. And then you have on the other side of the spectrum, you have tenants saying, we are not paying rent for 3 months. Too bad. And, and there's no plan, there's no discussion, and we see everything in between. We also see some QSRs, which we know are profitable, that are saying we're not paying rent. So it's really a case-by-case basis, tenant by tenant, location by location, and lease by lease. And that's why, this is what we do on a daily basis, and we have an exceptional amount of resources and a super team dedicated to this endeavor, and we're happy to help you, again, in real time, because one of the things that James and I struggle with is putting this together. As you'll notice, it's not super polished because we didn't practice it for 2 weeks, because it's such an ever-changing environment, and all these details and facts and fluidity are occurring at such a rapid rate that, we would recommend you have someone in your corner that can respond in real time. And we pride ourselves on our responsiveness, and we're happy to help you in any way we can. So, let's determine what your situation is and how you can best thwart any type of risk and certainly fortify your position both from an income and an equity perspective.
So thank everyone for joining us today. Obviously, as Jim mentioned, things are changing every day. So we're going to do our best to keep you updated on new changes as they come. We're sending out emails each week on the top 10, most relevant commercial real estate and investment articles. We know that your email box is probably getting bombarded by a number of COVID-19 emails. And so we want to limit that by trying to synthesize a lot of that information for you. And so those will be going out weekly as well instead of our regular articles, because things are changing so quickly. We want to make sure we stay relevant. So if you have any other further questions, feel free to reach out to us directly, send us an email. Again, we do hope that this was super valuable for you, and let us know if you enjoyed it. We're considering doing this more regularly. So if it's been helpful, please do let us know. We appreciate it, and hope you guys all stay safe out there with you and your families.